Hello friends! Welcome to our channel, American Systems Explained. Today's video is about understanding FICO scores and how they affect you. This is a system many people hear about, but few fully understand. It touches daily life in quiet ways, from renting an apartment to buying a car and even getting a phone plan. This first part is designed for beginners. The goal is to explain what a FICO score is, why it exists, and how it is calculated, step by step, using clear examples from everyday life in the United States. Let us begin with a simple definition. A FICO score is a number that represents how risky it is for a lender to loan money to someone. The score is created by the Fair Isaac Corporation, which is why it is called FICO. Most banks, credit card companies, auto lenders, and mortgage lenders in the United States use this score as a standard tool. Think of the FICO score as a summary. It takes years of credit behavior and compresses it into a 3-digit number. That number usually falls between 300 and 850. Higher numbers suggest lower risk. Lower numbers suggest higher risk. Here's a simple question to consider. If two people ask to borrow money, and one has a long history of paying bills on time while the other has missed many payments, who seems safer to lend to? The FICO score is designed to answer that question quickly. Now let us talk about why this system exists. In the early days of lending, decisions were made by people who personally knew the borrower. A local banker might know your family, your job, and your reputation. As the US economy grew, lending became larger and more national. Banks needed a consistent way to evaluate millions of borrowers they did not personally know. The FICO score became a solution. It offered a standardized database method to predict how likely someone was to repay a loan. This allowed lenders to make faster decisions and offer credit to more people across the country. Did you know that FICO scores have been used in the United States since the late 1980s? Over time, they became deeply embedded in the financial system. Now let us explain what a credit report is, because the FICO score comes from it. A credit report is a detailed record of how someone has used credit over time. In the United States, there are 3 major credit bureaus. They are Experian, Equifax, and TransUnion. Each bureau collects data from lenders and creates a report for each consumer. A typical credit report includes several sections. First, personal information. This includes name, address, and social security number. This section is for identification only. It does not affect the score. Second, credit accounts. These are credit cards, student loans, auto loans, mortgages, and other accounts. The report shows when each account was opened, the balance, the credit limit, and whether payments were made on time. Third, credit inquiries. These show when a lender checked the credit report because the consumer applied for credit. Fourth, public records and collections. This can include bankruptcies or accounts sent to collections. The FICO score is calculated using information from these reports. It does not include income, job title, education level, or savings balance. Let us pause for a quick recap. A credit report is the raw data. The FICO score is the summary number created from that data. Keeping this difference in mind helps avoid confusion later. Now let us break down how the FICO score is calculated. FICO uses 5 main categories. Each category contributes a certain percentage to the score. These percentages are approximate, but they are widely accepted. The first and most important category is payment history. This makes up about 35% of the score. Payment history answers a simple question. Does the person pay bills on time? Late payments, missed payments, accounts sent to collections, and bankruptcies all fall into this category. The more recent and frequent the problems, the more they affect the score. For example, missing 1 credit card payment by 30 days can lower a score. Missing several payments over months can lower it much more. Here is an important point many people miss. Paying on time means paying by the due date, not just eventually paying. Even if the bill is paid later, the late mark can still appear. Let us move to the second category, amounts owed. This makes up about 30% of the score. This category looks at how much credit is being used compared to how much is available. This is often called credit utilization. Imagine someone has a credit card with a $10,000 limit. If the balance is $1,000, that is a 10% utilization. If the balance is $9,000, that is a 90% utilization. Lower utilization generally helps the score. High utilization can hurt it, even if payments are made on time. Here is a question to think about. Why would using too much available credit matter if payments are on time? The reasoning is that someone close to their limit may be under financial stress and could struggle later. Third is length of credit history. This makes up about 15% of the score. This category looks at how long credit accounts have existed. Older accounts help because they show a longer track record. This is why closing old credit cards can sometimes lower a score. Even if the card is not used, its age still matters. For someone just starting out, like a college student, this category can be challenging. Time itself is a factor, and there is no fast way to replace it. Fourth is new credit. This makes up about 10% of the score. This category looks at how often new accounts are opened and how many recent inquiries appear on the report. Applying for many credit cards in a short time can signal risk. It can suggest financial trouble or There are two types of inquiries. Hard inquiries happen when someone applies for credits. These can slightly lower the score for a short time. Soft inquiries happen when someone checks their own credit or when a company sends a prior approval offer. These do not affect the score. Fifth is credit mix. This also makes up about 10% of the score. Credit mix looks at the variety of credit types used. This can include credit cards, installment loans like auto loans, and mortgages. Having a mix is generally positive, but it is a smaller factor. No one should open accounts just to improve mix. The system looks at overall patterns, not isolated actions. Let us pause again for a mini recap. The FICO score is based mostly on payment history and amounts owed. Length of history, new credit, and credit mix matter too, but less. Now let us talk about score ranges and what they usually mean. Although each lender sets its own standards, there are general categories many use. A score below 580 is often considered poor. Scores from about 580 to 669 are often considered fair. Scores from about 670 to 739 are often considered good. Scores from about 740 to 799 are often considered very good. Scores of 800 and above are often considered excellent. These categories are not rules. They are guidelines. A lender may approve a loan with a lower score or deny one with a higher score based on other factors. Here is a practical US example. When applying for a mortgage, a higher FICO score can mean a lower interest rate. Over a 30-year loan, even a small rate difference can add up to tens of thousands of dollars. For auto loans, a higher score can mean access to promotional rates. A lower score can mean higher monthly payments. For renters, some landlords check credit scores. A low score may lead to a higher security deposit or a rejection. Even insurance companies and utility providers may use credit-based scores in some states to set deposits or premiums. Did you know that employers usually do not see your FICO score? They may check a credit report for certain jobs, but the score itself is typically not shared. Now, let us address a common misunderstanding. Many people believe that checking their own credit score lowers it. This is not true. Checking your own score is a soft inquiry and does not affect the score. Another misunderstanding is that carrying a balance helps the score. Paying interest does not improve the score. What matters is responsible use, not paying extra fees. Let us also clarify that there is more than one FICO score. There are versions designed for mortgages, auto loans, and credit cards. Scores can differ slightly depending on the version used. This is why someone might see different numbers from different sources. The system is not broken. It is just using different models. As we close this beginner section, let us bring everything together. A FICO score is a tool It summarizes credit behavior into a number. It is built from a credit report. It focuses on patterns over time, not one moment. It affects many parts of life in the United States, often quietly. Understanding how it works is the first step. In the next part, we will go deeper into how actions affect scores over time, how lenders interpret them, and how real-life scenarios play out across different financial decisions. Before moving on, here's one final question to reflect on. If a number can affect so many opportunities, does understanding the system change how one views everyday financial choices? Now, we will understand FICO scores and how they affect you. In this section, the focus shifts from basic definitions to how the system behaves in real life. The goal is to explain why scores change, how lenders interpret them, and what happens when different financial decisions interact over time. Everything here is educational and descriptive, not personal advice. Let us begin by looking at how lenders actually use FICO scores. A FICO score is not a pass or fail test. Lenders use it as a filtering tool. It helps them sort applicants into risk groups. Once grouped, lenders apply their own rules. These rules are called underwriting criteria. For example, a bank may decide that applicants above a certain score qualify for lower interest rates. Applicants below that range may still qualify, but at higher rates. Others may require a cosigner or a larger down payment. This means two people with the same score could receive different outcomes from different lenders. The score opens or narrows doors, but it does not make final decisions by itself. Here is a question to consider. If the score is only one input, why does it matter so much? The answer is speed and scale. Lenders process millions of applications. A standardized number allows them to move quickly while managing risk. Now let us explore cause and effect within the FICO system. Many people expect credit scores to respond instantly. In reality, the system is delayed and layered. When a payment is made, the lender reports it to the credit bureaus. This reporting usually happens once a month. The bureaus update the credit report. Then the scoring model recalculates the score based on the updated data. This means actions today may not show results for weeks. It also means past actions can linger longer than expected. For example, a missed payment can remain on a credit report for years. Its impact fades over time, but it does not disappear quickly. On the other hand, positive habits often take time to build visible results. This delay often leads to frustration. People may feel they are doing everything right, but see little change at first. Let us talk about utilization again, but in more detail. Credit utilization is not only measured per card, it is also measured across all revolving accounts combined. Imagine someone has 3 credit cards. Each card has a $5,000 limit. That is $15,000 total. If the combined balance is $3,000, utilization is 20%. However, the system also looks at individual cards. If one card is maxed out while others are unused, the score may still be affected. This explains why spreading balances evenly or paying down high balance cards can change the score even if the total debt stays the same. Did you know that utilization has no memory? Once balances are paid down, the score can improve quickly. This is different from late payments, which linger. Now let us examine inquiries and new credit from a practical angle. Applying for new credit creates a hard inquiry. One inquiry usually has a small impact. Multiple inquiries in a short time can signal risk. However, the system also recognizes rate shopping. When someone applies for a mortgage or auto loan, multiple inquiries within a short window are often grouped together. This allows consumers to compare offers without severe penalties. This grouping does not usually apply to credit cards. Applying for many cards in a short period can still raise concerns. Here is a mini recap. Not all inquiries are equal. Context matters. Next, let us discuss credit mix and why it exists. Credit mix reflects experience with different types of obligations. Revolving credit, like credit cards, behaves differently from installment loans, like auto loans. Someone who manages both types responsibly shows adaptability. That is what the system attempts to capture. That said, this factor is small. Lack of variety rarely hurts as much as missed payments or high balances. It is a supporting detail, not a core driver. Now, let us move into real-life scenarios. Consider a young professional in the United States who just finished college. They have a student loan and one credit card. Payments are on time. Balances are low. The score may be solid, but not high. Why? The history is short. Over time, as accounts age and positive behavior continues, the score tends to rise. Nothing dramatic changes. Time does the work. Now consider someone who has excellent credit for years, then misses several payments due to a job loss. The score can drop sharply. Recovery takes longer than the fall. This highlights an important truth. Building credit is slow. Damaging it is fast. Another scenario involves closing accounts. Many people close old credit cards to simplify finances. This can reduce available credit and shorten average account age. Both can affect the score. This does not mean accounts should never be closed. It means actions have side effects. Understanding those effects allows for informed decisions. Let us also discuss how scores differ across industries. A mortgage lender focuses heavily on long-term stability. They care about payment history and debt levels. A credit card issuer may care more about recent behavior and utilization. Auto lenders may use industry-specific versions of FICO. That way, auto loan history more heavily. This explains why someone may qualify easily for one product but struggle with another, even with the same score. Did you know that scores can vary between credit bureaus? Differences in reported data can lead to slightly different results. This is common and not usually a sign of error. Now let us talk about myths that persist at the intermediate level. One myth is that income affects FICO scores. It does not. Income matters to lenders, but it is not part of the score. Another myth is that debt itself is bad. The system does not punish borrowing. It evaluates how borrowing is managed. Another myth is that there is a single perfect score. In practice, the difference between a very good score and an excellent score may not change outcomes much. Understanding these myths helps reduce unnecessary stress. As we approach the end of part 2, let us bring the pieces together. The FICO system responds to patterns, not one-time actions. It values consistency over intensity. It rewards time, patience, and predictability. Scores rise when behavior aligns with the system's expectations. They fall when signals suggest instability or risk. In the next part, we will explore advanced dynamics. This includes long-term consequences, compounded effects over decades, and how the system shapes financial paths across adulthood. Before moving forward, consider this question. If the system rewards predictability, how might that influence the way people structure their financial lives over time? This part of our video is on understanding FICO scores and how they affect you. In this final section, the focus is advanced understanding. We will look at long-term consequences, compounded effects over decades, and how this scoring system quietly shapes financial paths in the United States. This is educational context, not personal advice. Let us begin with the idea of compounding effects. Most people think of compounding in terms of interest. Credit scores compound in a different way. Small differences early can lead to large outcomes later. For example, a person with a slightly higher score may qualify for a lower interest rate on a car loan. That lower payment makes monthly cash flow easier. Easier cash flow reduces stress. Lower stress makes missed payments less likely. Over time, this reinforces positive credit behavior. On the other side, a person with a lower score may face higher rates, higher payments, strained budgets. Strain increases the chance of late payments. That can further lower the score. This creates a feedback loop. The system does not intend to reward or punish. It reacts to signals. Over time, those reactions can amplify differences. Now let us talk about life stages and how credit scores interact with them. in early adulthood. Credit history is thin. Scores are often moderate. At this stage, access matters more than pricing. Being approved for basic credit products allows history to form. In midlife, scores often peak if behavior has been stable. This is when major decisions happen. Home purchases, business loans, and refinancing often depend heavily on credit standing. Later in life, scores may stabilize or decline slightly as borrowing decreases. At this stage, the score may matter less day to day, but it still affects insurance, housing options, and legacy planning. Understanding where someone is in this cycle helps explain why the same score can feel very different at different ages. Let us examine long-term negative marks. Late payments, collections, and bankruptcies remain on credit reports for years. Their impact fades, but they shape lender perception during that time. The key advanced insight is this: time alone does not heal everything. Time combined with consistent positive behavior does. A report that shows old problems followed by years of stability often scores better than a report with no major problems but recent instability. Lenders look for patterns. Recovery is possible, but it requires patience and predictability. Now, let us look at strategic trade-offs. The system creates, the FICO model rewards, keeping accounts open and balances low. At the same time, people may want simplicity and fewer accounts. The system rewards cautious borrowing. The economy often encourages spending and leverage. These tensions mean people constantly balance convenience, opportunity, and system response. Understanding these trade-offs helps explain why people with similar incomes and education can end up with very different financial outcomes. Let us also discuss the broader economic role of FICO scores. From a system perspective, credit scores help allocate capital. Money flows more easily to borrowers, seen as lower risk. This supports stability in lending markets. However, it also means access to affordable credit is uneven. Past behavior strongly influences future opportunity. This feedback effect is one reason financial education matters. Understanding rules changes how people interact with them. Did you know that credit scores influence interest rates across the entire economy? When average credit quality improves, lenders can offer better pricing overall. Now let us shift to actionable understanding. These are not instructions, but observations viewers can use to interpret the system. First, consistency matters more than intensity. One large payment does less than many on-time payments over years. Second, utilization is a lever with fast feedback. Balances affect scores quickly in both directions. Third, age is valuable. Older accounts act as anchors in the scoring model. Fourth, recovery is possible, but it is gradual. The system remembers instability longer than stability. Fifth, the score is not identity. It is a snapshot of behavior within a defined framework. Now let us summarize the entire video with clear key points. FICO scores are numerical summaries of credit behavior. They are built from credit reports maintained by U.S. credit bureaus. Payment, history, and amounts owed carry the most weight. Time plays a central role in both growth and recovery. Scores influence access, pricing, and long-term financial paths. The system responds to patterns, not intentions. As we close, it is important to step back. The FICO score is a tool created for efficiency and risk management. It is widely used because it works at scale. It is not perfect, but it is influential. Understanding how it works allows people to see outcomes more clearly and interpret decisions more accurately. Knowledge does not remove constraints, but it reduces confusion. We hope this video was worth your time. If you found it helpful, please like, subscribe, share, and leave a comment below. Your feedback helps us create more content like this. See you in the next video!